Good morning, good afternoon, and thank you for joining our Climate Week New York webinar on managing risk amidst climate change. My name is Mardi McBrien, and I'm the Managing Director at the Climate Disclosure Standards Board. And I'm delighted today to be joined by some of my most favourite people in the whole world working in this space at the moment, Joe Paisley, Rodney Owen, and Robert Litterman. First of all, this event, as you all know, is being live streamed on CDSB's LinkedIn, Facebook, and YouTube channels. So please submit your questions simply by typing in into the video, below the video on these platforms, or email us at info@cdsb.net. And so when you're thinking about your questions today, have a think about our panelists and their specialisms. So Joe Paisley, who I'll get a long biography on in a second, is a finance banking background, risk management thinker. You know, what sort of questions can we be posing to Joe? What can we draw out of her today? We've got a huge mix of people that have joined us: sustainability professionals, risk management professionals, governance, people just interested in this space. What questions can we pose to Joe? Then we've got Rodney Owen, and Rodney's been, he's been in the deep, dark depths of big organizations looking at the enterprise risk management. He's worked in audit, and now he leads, the redefining values, thinking about how companies are thinking different about many of these issues, and they're the most sustainable advanced companies in the world. What questions do we have from Rodney? What practical tips and insights can we pose to him later on to see how we can move this agenda forward? And Rodney's done lots of great stuff, so I'm looking forward to hearing about that. And then we're over to Bob. Bob is a chair of the risk committee, managing partner, C-suite level at Kipos Capital. What can we be posing to him from the top down to sort of drive the narrative from top to bottom? So have a think about that as our panelists are talking today. Pop your questions, as I said, in the link at the bottom on the platform you're working on, and we'll make sure we get to them at the end for you today. So without further ado, I'm going to hand over to Joe Paisley. And Joe is going to talk more broadly about the financial impacts of climate change and set the scene for us today, and the role, and a bit of the role of the risk management professional, which is also going to touch on the findings from a recent Global Association of Risk Management Professionals survey that looked at how climate is embedded in the risk management, in risk management in financial institutions. And she may also touch on scenario analysis and new capacity building resources that are out there for you. But Joe, as I said, her background is she's co-president of the GARP Risk Institute, which is part of the Global Association of Risk Professionals. She's worked as global head of stress testing at HSBC from 2015 to 2017, and has served as the stress testing advisor at 2 other UK banks. She's director of the Supervisory Risk Specialist Division at the Prudential Regulatory Authority, and Joe has been closely involved in the design and execution of the UK's first concurrent stress test in 2014. Now, I particularly know Joe as one of those people that likes to get large groups of people together, all doing good things, and make them work more closely together to get good outcomes. So I'm so happy Joe is here today. So please, Joe, take it away.
Thanks a lot, Mardi. And delighted to be here today, which I think is really partly to launch the course that we put together that's now on the TCFD hub, which is about an introduction to managing the financial risks from climate change. And it's not aimed at risk professionals particularly, it's aimed at everybody in any sector of the economy. For those of you who don't know, GARP is a US-based non-partisan membership organization, and we are passionate about risk education, and the bit that I work in, the thought leadership arm of GARP, is doing an awful lot of research and thinking about climate risk. And our main aim really is to build capability and knowledge as quickly as possible, because we do believe that, you know, there's an urgency about this. So we were delighted to help put the course together. If we just go to the next slide, I've actually cheated a bit because I've taken 3 slides from the course, and I don't know who's, here we go. Right. So the first thing that we tend to think, sometimes it's obvious, but sometimes it's not obvious. It needs to go on mute, actually. I can hear some background noise. Is that there are 2 different perspectives when it comes to climate risk. The first perspective is our impact on the climate, and you see that here on the left. So that could be through emissions from transport or heating, deforestation, food production. But the second perspective is the impact that the climate has on us. And you can see it really well summed up with this train trying to get through flooding. And to add more complexity, these 2 perspectives are actually interrelated over long periods. So the more that we impact on the climate, the more that it will change, and the more, therefore, that it will impact on us in turn. Now, when it comes to corporates in the real economy, they need to be assessing risk from both perspectives. So corporates need to assess how they impact the climate, because the more emissions that they have could lead not only to reputational risk and liability risk, but they're also a proxy for their exposure to what we call transition risk. That's the risks that will arise as we transition to a low carbon economy. And companies and industries with high greenhouse gas emissions are more likely to be impacted by a transition to a low carbon world directly than those with low carbon greenhouse gas emissions. But corporates also need to think about the impact that the climate has on them, because they need to understand their financial exposure to physical risks. They're the risks from weather-related events, as you can see here, from flooding, from more intense rainfalls, from wildfires. We see that live at the moment in California, and those sorts of climate-related events. So physical and transition risks are really important for great swathes of the economy. Now, when it comes to financial firms, and GARP tends to work quite a lot in the financial sector, they actually have relatively low greenhouse gas emissions. If you think about a bank, they're not big emitters of carbon. But their main financial risk is their exposure to corporates and households, but corporates in particular, who themselves are large emitters of carbon. So when we look at the financial system, they're going to be thinking more about trying to assess the transition risks for firms in the real economy. And we see increasingly with regulatory scrutiny, for example, that financial firms are really trying to increase their capability and awareness of how to do this. And we'll come on to talking a little bit about what we see across the financial system in terms of their capability of managing these risks in a little while. Just to make these 2 perspectives a little bit clearer, I just want to move on to the next slide, which gives you a really good example, probably the most extreme example of any sector. And this is the energy sector. And here on the left, you can see the energy sector's impact on the climate, in the sense that they have been a major contributor to greenhouse gas emissions, with the use increasing exponentially since the start of the Industrial Revolution. And then if you look at the figure on the right, the climate's also going to expected to impact the income and profit and the returns from the energy sector. So in an environment in which we've limited global warming to, say, 2 degrees, the returns that you can expect from fossil fuel energy companies could decrease significantly, whereas the returns from renewables will be expected to increase. So we're going to get real financial impacts on these companies. So, for example, the coal industry is expected to have no value by 2050. The oil and gas industry is expected to have virtually no value, whereas renewables could have an increase in value by 150%. Now, this is a very, very simple example, if you like, but the point is that certain industries will be more or less heavily affected by changes in regulations, changes in consumer sentiment, changes in technology, and all these things will be part of the transition. And the energy sector is not the only one. And you'll find that in the course, we give a couple of other examples, the transport sector and the food sector, just to make the point that across the whole economy, firms are going to have to start thinking very, very seriously about the impact of the climate on them and their impact on the climate. From a risk point of view, this is really difficult because we'll come on to it in a little while, but one of the main things is that these risks aren't priced. But also, we don't know what the future is going to be. So if we look at the next slide, some of you who are familiar with this may be familiar with this particular chart. It shows multiple different pathways in the future of emissions. So if we are successful in curbing emissions, which we all hope we are in an orderly way, then we will transition to a low carbon economy. But if we're not successful and emissions keep rising, then we will get an increasing number of physical risks and they will become more and more extreme. And there is, to some extent, a bit of a trade-off between the two, but they are very interrelated as well. And so this makes it very, very difficult for those in business and in the financial system to kind of guide their way or to manage the risks, because we actually don't know which path we're going to be on. That's why tools like scenario analysis, which Mardi mentioned, are becoming increasingly important, because we have to start thinking about multiple futures and how we're going to navigate these different types of risks and different types of worlds. Let me just now turn to what we see across the financial system, again, just to set the scene for the others, really. So if we turn to the next slide, this gives us the structure of our climate risk management survey, and we did it for the second year this year. It's all anonymous because it's not a naming and shaming exercise. We really are trying to build capability and help these firms understand how mature they are and what is emerging leading practice. So we look at the main themes from the TCFD. We're not trying to work out how good the firms are at TCFD. We're trying to look at how good they are at climate risk management. But the categories here are the key categories that correspond to good risk management. So we start looking at, for example, how engaged are the board and senior management? Has the firm assessed their risks and opportunities? Is climate risk integrated in their day-to-day risk management? Does the firm use metrics, targets and limits, and so forth? And just in the little box at the bottom, I don't know if you can read that, but we had 71 firms across the globe, comprising 43 banks and 28 others, which are asset managers, insurance and financial market infrastructure. And collectively, they had a market capitalization of 3.8 trillion. So this is a big sample. They've got some of the biggest companies, financial companies in the world in this sample. I'm not going to go through all of the results, but you can go to climate.garp.org to see the results and more of our resources. But I thought I'd just pick out a few that are highly relevant, I think, to Rodney and Bob. So in terms of the risks and opportunities, we wanted to ask the firms, what do you expect to have a major impact on your strategy? On the risk side in green or the opportunity side in black. And what's interesting is that for these firms, in the next 5 years, they actually see a bigger impact on their strategy from the opportunities, which I think highlights the commercial imperative for firms to really start thinking about this. There's a risk, actually, if you don't do it, that you're going to miss out. One of the other key things that we found, if we go on to the next slide, which I think is very pertinent to some of the difficulties that risk managers have, just on the next slide, please. is that these risks aren't being priced yet in market products. And so only 4% of all of the firms that we surveyed thought that these risks were being priced into market prices. That doesn't surprise me at all, actually. It's extremely challenging to price it. And at the moment, we don't have a carbon tax either. So that makes it even more challenging. And I think also the longer term forecasting of climate change and its impacts are highly complex. There is a lack of robust and reliable data, and it's difficult to combine the short-term focus of pricing models with the longer-term nature of climate risk. So there's a host of different challenges firms need to overcome. Just the final couple of slides I wanted to outline. If we just go to the next slide, please. What we do is, no, not that one, the one before that, please. What we do, I don't know if we can get that one back. Yep, here we go. Thanks. So we had 6 categories, and we score the firms according to how good they seem to be on governance, strategy, risk management, and all these others. And each firm gets their own score, so they understand where they are in the pecking order. But the key point I wanted to make here was really there is an enormous range of practices here, from firms that are really very advanced, really getting to grips with this, to firms that are really just at the beginning. And Mardi, I'm going to use the word journey. I know you hate it, but firms are on a journey. And the firms that are scoring more are typically the ones that started longer ago. So they've just had more time. And that is a big message, actually, for us, that you just need to get started on this because it takes time. If we go to the last slide, please, and then I will round up and hand over to Mardi. We got the next slide. I can't see it yet, but the final slide, here you go. It's a bit of a plug, not just for GARP, but also for the TCFD Knowledge Hub, where our course that we put together, and I do want to just call out the contribution from my colleague Maxine Nelson, because she did an awful lot of work for this course. That's now housed on the TCFD Knowledge Hub, along with 5 other courses. It's an introductory course to managing the financial risks from climate change. Beyond that, GARP itself has many resources, including our new certificate on sustainability and climate risk. And I think that's really interesting that, you know, it's the first major project that GARP has come out with for about 11 years. We're well known for the FRM certification and the ERP certification, but we recognize the importance of climate risk, and it really are in the foothills of establishing new approaches, new methods, methodologies. And so we see it as vital that as many people become familiar, at least with the basics, and then when they want to know more, then there are these kind of offerings that can help them become more advanced. The other thing I would just note, certainly in the UK, and I'm sure that, Mardi, you'll be familiar with this, the Climate Financial Risk Forum is also a really useful hub on the FCA website. For those of you who don't know it, it's the forum was put together by the UK regulators, the PRA and the FCA, and they brought 5 asset managers, 5 banks and 5 insurance companies together to create this forum, where the regulators and industry actually have a really good open dialogue about emerging trends in risk management, scenario analysis, also disclosures and innovation. And there's a lot of very useful resources there. And the reason I put it up there is partly because I think it's very, very useful for you, but also just to know that GARP was the secretariat to the risk management and scenario analysis working groups. And we found it incredibly valuable as a really rich set of information on the FCA's website. But we also got the impression that, you know, there is this range of practices, and we can only hope that through efforts like the TCFD Hub, CDSB, GARP, and a range of other actors as well, that we get that awareness and capability building as quickly as we can. Anyway, I think that's me for now. Over to you, Mardi.
Thanks, Jo. And I couldn't echo more about getting the capability in place, upskilling, creating that common practice that can, you know, evolve into that best practice that we so desperately need. Now, I'm going to hand across next to Rodney Owen. who is going to talk about the role of the risk management professional, how to apply risk management frameworks to climate change, and the work they've been doing at WBCSD over the last 5 years in the Redefining Value program in this space. So Rodney Irwin is the Managing Director of the World Business Council is the Managing Director of the World Business Council for Sustainable Development, WBCSD's Redefining Value and Education programs. And he's also a member of the senior management team then. And Rodney's responsible for overseeing projects designed to help companies measure and manage risk, gain competitive advantage, designed to seize new opportunities by understanding ESG information. He's the link between WBCSD members and major standard setters and regulatory bodies, and manages all the key education relationships as well. And education is something very close to Rodney's heart, with close relationships with organizations such as Yale and Lancaster universities. So to add to all of that, Rodney is extremely well qualified to be on our panel today. He's a fellow of the Institute of Chartered Accountants of Ireland. He's a certified fraud examiner, a certified compliance and ethics professional, and a specialist member of the Institute of Risk Management UK. He sits on the council of the IIRC and is a board member at CDSB, where I absolutely welcome all of his inputs, guidance, and advice. So over to you, Rodney.
You are in the world. It's a pleasure to be speaking with you today. I know today's topic is around climate risk, but before we go there, I think we need to acknowledge a few things first. The reason that we're doing this online isn't because of climate, it isn't because of choice, it's because of a virus that's made its way from the animal kingdom into the human population. And nobody on this planet has been unaffected by the effects of this virus. However, how many corporations identified a pandemic as a risk? Well, I don't know the answer to that, but I know it's exceptionally low. Even the World Economic Forum's risk report of 2020 identified a pandemic, a health pandemic, as being a high impact category, but likelihood was not there to make it go into the top 10. However, it's the second global pandemic in 11 years, and it's the fourth respiratory illness of a COVID virus in the last 18 years. So the question I want to pose is, why are these signals not being captured by businesses, by investors, by risk professionals? And why are we not able to embed these into risk management practice? Because there is a risk that we have been told by the World Health Organization for the last 20 years that there was going to be a big virus, there was going to be a problem, and we needed to address it. And in my former work as a risk manager at a global transport company, we were very, very focused on H1N1 when it happened in 2008. But why in 2020 are we still not able to take the signals that we're receiving from the world and embed them into risk management? I don't know the answer, but I have some theories, and climate is going to be no different. So let's have a look at the signals we're getting. We can go to the next slide. Climate change isn't a risk. It's actually a reality. Climate change is not, unless you're joining this and you're a climate denier, then, you know, good for you. But if we believe, as we should, the science, climate change is not a risk, it's a reality. And what businesses and investors are now dealing with is the effects of climate change. And if we build up this slide, you can see, first of all, that some businesses are now seeing climate change as a material financial impact. So the water levels in the River Rhine are just one example of how businesses that depend on that arterial transport route having to issue profit warnings because the supply of raw materials and the distribution of finished products were impacted. Here we see a press release relating to BASF, but Shell and other companies were impacted. And if we look then at other, as the slide builds up, we've got the California wildfires and the implications that has on insurance. If we look at the next one, we're starting to see that like Joe has already said, that financial players are exposed because they're seeing risks associated with their investments being written off. Others are starting to say, oh, we're going to invest 100 billion into tackling climate change. And then the last one we see, is that we know this is material, but what are you doing about it in your corporation? How are you modifying your risk management practices so that these signals are being brought to the attention of those that can put in place corrective actions, and disclosing that you are taking these risks seriously and that you are pursuing strategies to limit the impact of these risks? So if we go to the next slide, I would just like to say that today, COVID has proven that we're not embedding signals into our risk management practices. And if we look at what science is telling us about climate change, the trajectory that we're on is way in advance of what is considered to be a safe operating space for humanity. We are not on track. But let me bring it even more to a sobering level and show what we at the WBCSD have been doing to understand disclosure practices and as a proxy for risk management practices relating to these topics. In 2017, during the World Economic Forum, the WBCSD published a research study into how to integrate sustainability or ESG impacts and dependencies into enterprise risk management. Now, this was a study that we conducted across our members, and since then we've expanded our scope beyond the membership into the world's top 200, 300 companies. But the results of this are quite staggering. Now, what we did before we move to the next slide, I'll just explain the methodology. We looked at what companies are disclosing in their risk reports, whether it's in the risk factors or it's in their annual report or in their legal filing to an audience that they are obligated to report the risk profile to. We've also then looked at what are the material sustainability challenges that the company has identified and reported as part of their sustainability communication. And what we did was a desktop research to compare the sustainability disclosure with the legal filing disclosure as a proxy for what may be going on in the risk management practices. And what we found was the following in the next slide. We found that from the population that we looked at, only 8% of the companies had a full alignment between what they disclosed as a sustainability material issue and what they disclosed as a risk. In the next slide, we found that 57% showed some partial alignment, and further analysis of this showed that that partial alignment was where there was a regulatory requirement to potentially disclose a particular ESG factor. But most shocking of all was that 35% of the companies that we looked at had zero alignment. That meant that 35% of the population of nearly 300 companies said, we have a material ESG issue in our sustainability report, but the risk management practice had no reference to that in the disclosure that was being made. Now, that was desktop research. So we followed that up with a triangulation approach to talk to over 30 companies to say, what's happening? Why is there this disconnect? Or why are you getting it such that there's full alignment? And what we found were 8 reasons why there was a disconnect. And I'm not going to present them in detail, but simply it was, can we go back to the previous slide, please? What we found was that the two communities just didn't speak to each other as a basic, risk management and sustainability. Hello, you work in the same company, you'd be good for each other to have a conversation. What we also observed is that where they were communicating with each other, there wasn't effective communication, and that the terminology, the language used was not hitting the mark. We also found that the risk management community found it really hard to quantify for their processes what sustainability impacts and dependencies were, etc. You can go to the research, it's available online, and have a look at it. Now, we've updated it since 2017, and the next slide shows where we currently are at. And I'm afraid the picture is still not great. We're now seeing that the average alignment has gone from 29% to 36%, so that's an improvement. And the number of companies that have zero alignment has reduced to 24%. But in this day and age, with all of the signals that we're receiving from the planet, from society, from scientists, from experts, these numbers are still too high. What we see also is that there's a divergence between what Europe is doing versus the US and versus Asia in terms of headquartered companies embracing these challenges. So what we're observing is that we are still not listening to the signals that we're getting to these risks. And why is that happening? What do we need to do to change risk management practice such that these risks not only get identified as potential risks, but also get prioritized as risks that need to be addressed, or as Joe mentioned previously, as opportunities that need to be pursued? So if we go to the next slide, please, we can see that the TCFD, particularly when it comes to financial risks related to the transition and physical exposures associated with the transition to a low carbon economy, we have great guidance and direction from the authoritative TCFD on what sort of things we need to look at. We need to look at the transition risks, as you see here, the physical risks, as well as the opportunities. And we need to embed that into the way in which we make strategic planning, in the way in which we embrace sustainability as part of risk management practices. And if we go to the next slide, we know that there's a lot of developments out there that's saying we need this to happen. Only last week, the Australian or the New Zealand government mandated that TCFD disclosure-like requirements would now be a requirement in that country. We've seen the FSB take stocktake on climate risk. We've seen investor groups call for companies to disclose climate-related information and for the regulators of accounting standards to do so. We've seen the same coming in from the UK government, for example, in asking pension schemes to be aligned with TCFD recommendations. So whilst it's still a voluntary initiative, there's a lot, in many cases, there's a lot of pressure now being placed on businesses to start to disclose this information. But what is it going to take for businesses to go that extra mile? And I think there are a number of challenges that we need to overcome. First of all, as risk professionals, we need to be really critical of our use of probability in determining whether or not these risks are likely to happen. If COVID has taught us anything, is that we cannot predict with any degree of certainty what the impacts or what the likelihood of certain issues are. But we can change the narrative. We can move away from our obsession with probability to a more cerebral approach to looking at our vulnerability to these shocks. And maybe we need to evolve away from risk management as a discipline into something more like vulnerability management by simply asking ourselves the question, how vulnerable are we as a business to these issues if we were to be presented with them in the next 1 month, 1 year, 2 years? Now that's a different question than saying, how likely is it to happen if we were to be confronted with another pandemic? As human beings, the future is always coated in rose-tinted glasses. And if we consider, and we've just spent our time building a strategy, it's very difficult for us to say it's not going to work. So we maybe need to look at the nuts and bolts of the way in which we define risk to see if we can get these issues at the table of the decision makers. But we're still not there. And the next slide I think I want to present to you is just another sobering slide around just how difficult the TCFD is seeing implementation of climate risks into enterprise risk management. Now, this came from the Financial Stability Board's report of last year. And you can see here that the areas that are pink are particularly along those industries that you see along the top. Integration of climate-related risks into overall risk management continues to be a problem. So why is this the case? And our work at the WBCSD has identified another few things that we need to address. In the next slide, you'll see that climate risk, along with other ESG risks, has very challenging characteristics, but they're not insurmountable. We know that these risks are uncertain and novel, but that doesn't mean that we can't address the vulnerabilities presented by them. We know that they have different effects in different sectors and different geographies in different regions. We know that they are not linear, and that their magnitudes can be from very insignificant to exceptional, as we're seeing today in California and across the Western USA. They're also complex and they need to be interconnected. So, you know, the map we see at the center here shows that a networked implication of these risks needs to be understood. And the time horizons are longer than what we normally look at when it comes to risk management. And again, when we use longer time horizons and probability, it's not going to happen. But if you change that to vulnerability, it could be something that starts you to focus your attention on prioritizing these risks for being managed. So in my last slide, and before I hand back to Marty, risk management integration and practice, what I think we need to do. We need to look at the risk appetite of the company, and we need to expand the assessment time horizons. We need to address the assessment criteria. And I personally would love to see the death of likelihood, as our ability to predict the future has proven to be woefully inadequate, and maybe embrace vulnerability as a criteria. We need to look at connectivity, and we need to look at the velocity with which these risks are presenting themselves as part of our risk management practice. We need to use tools, whether it's scenario analysis, etc. And we need to ensure that we are doing risk management, not risk reporting. And we start to disclose not only what the exposure is, but what our corrective actions are, so that companies can be rewarded for the investments and the energy that they're putting in to creating corrective actions. Thank you.
Thank you, Rodney. So it's the death of likelihood and the rise of vulnerability as is some of our takeaway thoughts from that. Now, I know, Rodney, you've spent a lot of time, and this time last year at Climate Week, we ran an in-person workshop with, I think, 60 professionals on risk management. And for those of you that haven't been lucky enough to play it, WBCSD has some great sector-based risk games you can play with your team and cross organizations to sort of break down some of that language challenge that we heard earlier. And so I urge you to go onto their website and work out how to get them, because they are hugely fun. And I know even my team at CDSB, when we play them, like, share price goes up, we win, oh, it's gone up, and it plummets, you know, when the price of something, the price of the next commodity goes down and gets flooded. And really good for breaking down barriers and introducing, you know, people that might not be that familiar with climate change into what it looks like on a day-to-day basis. But just a quick question, Rodney. I know you've done quite a lot of work on enterprise risk management, developed guidance with COSO. Could you tell us a little bit about that and how that can help companies as well? Just
so
before we
many of you will be
to
familiar with the COSO enterprise risk management framework. Hopefully you're familiar with the 2017 version and are not still obsessing over the 2004 cube. Things have evolved. For those of you that know the old approach, one of the disadvantages of the old approach to risk management was that it started off by asking you to look inside the corporation. Interrelated component number one was look inside the organization, inside, when all of these issues are happening outside. So the evolution of the new framework in 2017 that COSO published was a really good step in the right direction of embedding risk management as part of strategy and governance. And we, at the same time, were in conversations with COSO about working with them to develop application guidance on how to embed ESG-related risks into enterprise risk management. And in 2018, we published our guidance. It is fully aligned with COSO, but it can also be used with ISO or any other risk management framework that you've got. So though it is branded with COSO and developed with them, it is not welded just to their framework. Now, what that guidance does is it allows for the issues that we identified in our research to be overcome. And it's been written with the sustainability professional and with the risk professional in mind. And it allows them to have good conversations. I personally believe that risk management is nothing more than good conversations. The problem is we don't have good conversations generally. We tend to sometimes avoid the elephants in the room, even when they're dancing like they do on that famous cartoon that we had from Walt Disney. We have to start being open about what it is the business is doing in terms of the context within which it operates. And we need to bring the professionals together that have that information so that those just charged with governance and decision making get the right information that they have. So the guidance is freely available, and the supporting tools such as the games, such as the diagnostic tools, are all freely available as open source to help with businesses having better conversations. So I would encourage companies to have a look at that. I would encourage anybody that's in the risk management space who would like to find out more about how we can support them to get in touch with us. But remember, all of this is happening. We see it, we hear it. Why is it not getting into your risk management practice? And only you can determine what those barriers are. And our tools are there to help you, A, with that identification, and B, to potentially overcome them.
Thanks, Rodney. And I think that leads us nicely on to Bob Litterman, who's going to talk to us about his experiences at Keepos Capital and beyond that, and earlier days at Goldman Sachs, and really what you're doing in this space. So just a bit of an introduction to Bob. So Bob is the chairman of the risk committee and founding partner of Keepos Capital. Prior to joining Keepos in 2010, Bob had I'm aging you unnecessarily there, Bob, my apologies, a 23-year career at Goldman Sachs, where he served in research, risk management, investments, and thought leadership roles. Bob was named partner at Goldman Sachs in 1994 and became head of the firm-wide risk function at that time. He's researched and published an amazing number of books and papers in this space, as well as the asset allocation and risk, groundbreaking papers in asset allocation and risk management. He's co-developer of the Black-Litterman Global Asset Allocation Model, a key tool for investment management, and has co-authored books including The Practice of Risk Management and Modern Investment Management, an Equilibrium Approach. He was inducted into Risk Magazine's Risk Management Hall of Fame and named the 2013 Risk Manager of the Year by the Global Association of Risk Management Professionals. You are extremely well qualified to talk about your experiences and build off our fellow panelists. Over to you, Bob.
Thank you, Marty. It's a pleasure to be here, and I guess I'd like to start by talking about some of the lessons from financial risk management that I was very familiar with, and all financial professionals really are, that also apply to climate risk. So the first one of those is just that we have to worry about the full distribution of outcomes. And when we think about climate and what might happen, as Joe mentioned earlier, there's many scenarios that could play out, and there's many dimensions to this. So you've got all kinds of impacts ranging from wildfires and hurricanes and floods and heat waves and droughts and so on. And they can interact, they can affect the prices of food, they can affect health, they can affect security. I mean, and so we don't have a lot of experience with this historically, and we know that these impacts are only going to increase over the next many decades. I've got grandchildren, and I'm sure they and their generation are going to be seeing these increasing impacts over the course of their lives. Now, the second lesson of risk management, in addition to having to worry about all those different scenarios, is the purpose of risk management. And many people think it's to minimize risk. That's not what it's all about. When Goldman Sachs asked me to be head of risk management, it wasn't because they wanted to minimize risk. It's because they wanted to get paid for the risks that they took. And they didn't want to take risks that they weren't getting paid for. And when Fisher Black and I built the global asset allocation model, it's all about balancing risk and return. In an equilibrium, investors get paid, first of all, not only for the expected outcomes, but also for the risks that they take. And this is a fundamental problem with respect to climate. Right now, as Joe mentioned, we're not pricing the risks. We're not pricing the expected outcomes, the damages, and we're not pricing the catastrophic outcomes that might occur, particularly if we just keep on not pricing this. The financial market's incredibly efficient at allocating capital in the direction of the incentives that it's given. I worked as a financial engineer for many years, trying to take advantage of every little basis point of opportunity and hedge out the risks to allow that to happen. And so financial markets are really good at that. But when the incentives go the wrong way, then the capital flows in the wrong direction. And it's not just capital, of course. Consumers are making wrong decisions. Businesses are making wrong decisions. We're all pointed in the wrong direction. And so, whether we think about it or not, the incentives go the wrong way. We make the wrong decisions. So we've got to fix that. That's just a fundamental flaw in the system. And then the third thing that I want to focus on is urgency. When you're managing risk, time is a scarce resource. If we have enough time, we can solve almost anything. It's when you run out of time that a risk can become an unmanageable catastrophe. And right now, where we are with respect to climate is we don't know how much time we have. We're filling the atmosphere with a pollutant that has long impacts. Right now, the flow of that emissions into the atmosphere is as high as it's ever been. And it's the stock of these emissions in the atmosphere that it creates the warming. So there are these long lags. And right now, the trajectory that we're on is something that has to be changed dramatically. And the way that's going to change is we're going to create appropriate incentives to reduce emissions. And that has to happen globally. This is a global problem. So there's a couple of lessons that Rodney mentioned from the COVID crisis. I think they're really important. These are both risk management challenges. What we saw with respect to the COVID crisis is that we didn't address it in time. There was a Columbia University study that suggested that had we addressed COVID 1 week earlier, we could have cut the number of deaths in half. And similarly, with respect to climate, we don't know how much time we have. We're on a trajectory today. If we were to price emissions at an appropriate level immediately and have a phase change in the economy and all of a sudden be reducing emissions, it would take us probably till 2050 to get to net zero. And what that means is the maximum temperature would occur around 2070. And it would be probably 1.8 degrees, something like that, somewhere between 1.5 and 2. And the UN just last year published a report suggesting the enormous difference between 1.5 and 2. 1.5 is already terrible. We're at 1 degree C already. At 1.5, the UN IPCC projects that we'll lose between 70 and 90% of coral reefs in the oceans around the world. Now, that's a catastrophe, I think, by any standard. If we get to 2 degrees C, they say we're going to lose more than 99% of coral reefs. And so that difference between 1.5 and 2 is a huge difference in terms of expected impacts. And yet, for every 10 years that we delay pricing of emissions, that causes that maximum temperature to go up by about 0.3 of a degree C. So if we're at 1.8 today and we wait 10 years, we're going to be above 2 and basically guarantee that we're going to lose 99+% of coral reefs. So that's the urgency that needs to be recognized here. And now, just 2 weeks ago, the CFTC, the Commodities Futures Trading Commission, subcommittee on climate-related market risk, released our report. It was a group that I chaired, 34 institutions representing a diverse cross-section of financial market participants, including 3 banks, an insurance company, 2 oil companies, a couple of ag companies, some data companies, as well as academics, nonprofits in the environmental space, investors, asset owners. So you had all those different perspectives. And the CFTC commissioner, Rustin Benham, who sponsored this subcommittee, he asked us to create a high-level report. He hoped it would be less than 50 pages, and he wanted us to do it in a consensus manner. He basically said, what can you all agree on? Well, we found there were a lot of things that we could agree on. Our problem was we couldn't limit it to 50 pages. We ended up over 3 times that many. We came up with 53 very specific recommendations, and I want to focus on the first recommendation, which was that we need to put a price on carbon. Everyone gets that. When we sat down as a committee and went around the table, I said, it seems to me that number 1 risk management requirement is that we create appropriate incentives to reduce emissions. And everyone agreed. We went around the table. No one disagreed with that. The other thing we agreed on is that we are nowhere near adequate in terms of our financial risk management, both in terms of individual companies and their reporting, in terms of how it's integrated into the financial system, understanding what the risks are to the banks, to insurance companies, and ultimately to investors and asset owners. And so we have to have a leadership from the financial regulators in terms of developing the data, the analytics, the common understanding of metrics and decision, useful metrics. So we're at an early stage here. This has got to be a public-private partnership. It's got to be an iterative learning process, and it needs to be led by the financial regulators. And we have to move down this path very quickly. So we created what I think is a really useful roadmap, And, I think it'll be taken up by the regulatory authorities in the U.S. One of our main recommendations is that they need to coordinate with the regulatory authorities around the world, many of whom, especially in Europe, are well ahead of the U.S. So there's a lot of work to be done, and we need to get started. And the final thing I'll just mention is that, very sadly, the head of the Climate Leadership Council, Ted Halstead, passed away in a tragic hiking accident a couple of weeks ago. And Catherine Murdoch and I have now taken on the role as co-chairs of the Climate Leadership Council, which, as I'm sure many of our audience know, is the leading carbon pricing initiative right now on a bipartisan basis. And we're going to move that forward. And hopefully in the next couple of years, we will get carbon pricing at an appropriate level in the U.S., and hopefully that will lead to a global coordination and harmonized global pricing around the world. And when that happens, that's going to be a phase change in the economy. And I'll just mention that my own asset management firm, Kepos Capital, has launched a fund to take advantage of that rapid transition to a low carbon economy. And I think that probably all investors understand that we're on a path toward a lower carbon economy. I think what most of them don't recognize is how fast that's going to happen. And it's going to happen as soon as we price emissions. And pricing emissions is going to happen very soon as the political environment allows that to happen. And I think there is going to be a real swing back toward understanding the importance of trusting science and using that science to guide policy going forward. So I'll stop there.
Thanks, Bob. That was really, really interesting, and we have loads of questions and feedback come through. And I must say, good luck with your work at the Climate Leadership Council, because our fingers are all crossed. We're rooting for you all over the world to make this happen. So we've had a couple of questions asked about regulation and the role of regulation, and Rodney briefly touched on it. You've touched on it, Bob. Does this need to be mandated to make this happen at the pace that's needed?
Yeah, if that's a question to me, there's clearly a role for regulation. One of the things that our subcommittee pointed out is that we don't need new legislation. There's plenty of authority for financial regulators. They just haven't focused on climate risk. I will say that one of the reasons is because climate risk is in some ways very different than traditional financial risks. It's much more long-term, and we don't have the same experience, historical data and analytics and understanding of what's likely to happen. So there's a lot more uncertainty. And so again, what that really means is that we need to move forward quickly in developing the data, the analytics, the scenarios, the common metrics that allow for meaningful disclosure of climate-related risks and meaningful management of those climate-related risks, both from a systemic perspective and also from the perspective of individual financial institutions and other corporations, as well as investors and asset owners.
A question that has come through is, can we elaborate on more practical ways to institute incentives for climate change initiatives? And what would your top 3 suggestions be? Rodney, do you want to start? Or Bob, I don't mind who. Joe?
Well, let me just say that there's many forms of incentives, but the main one that we have to focus on going forward is a carbon tax. We have to price carbon, that's embedded in fuels, and then in addition to that, there's things like there's subsidies for renewable portfolios, and there's feed-in tariffs, there's fuel taxes on the other side, but there's also subsidies to fossil fuel consumption and production. So there's incentives all over the place in terms of what the economy can do. Some incentives go in the direction of reducing emissions, others in encouraging emissions, and what we really need globally is strong incentives to reduce emissions that can come through either a carbon dividend plan like the climate leadership proposal, or a carbon tax, or cap and trade. Lots of ways to do it. That's not what's hard. What's hard is getting the political will to actually do something.
Rodney, do you have a top 3?
No, I think Bob has hit most of them on the head. I mean, I'm coming at this really from the corporation side of the equation, and I you know, at the end of the day, incentives are what drive behavioral change. Very few companies today disclose not just climate change, but all ESG targets as part of executive remuneration, for example. So I would love to see that, you know, companies that are taking this serious are embedding that into the way in which they remunerate the executives who make the decisions and the investment decisions to address not only climate change, but other material ESG considerations. But of course, you know, the elephant in the room, was quite a few of them, is ensuring that, you know, these executives see that it's part of their fiduciary duty to address climate risk if it's material for their business. And I noticed in the chat function that somebody was asking particularly about the apparel industry. But of course, it's material for the apparel industry because, you know, it's a highly you know, it's a material for all industries, and it may not be material that you are having an impact on the climate. For example, that's the oil and gas industry, the electric utilities, the chemical sector, the heavy industrials. But as a sector, you know, you need to be looking at you know, your supply chain. You need to be looking at the effects of the climate agenda on your ability to secure raw materials, etc. So this needs a holistic approach, but it starts with the tone at the top. And if executives acknowledge their fiduciary duty and incentivize behavioural change within their organisation, that's to be encouraged.
I just jump in here, and this is one for all three of you, and it sort of links back to what you've just said, Rodney. It came through on Twitter. So the sustainability professionals in the company are brought in, and it nicely also links back to some of your slides, Rodney. Sustainability professionals are brought in. There's a group of staff brought in. They just can't get senior management and the board to buy in. What's your advice to those people out there on conversations to have? What coffee to buy, tea to buy? What's the advice the three of you could give those people trying to drive up through the business, not down from the top?
Well, I'd be questioning why they were brought in if nobody's listening to them. So I've always said that sustainability is not a department, it's not a report, it's not a mindset, it's a mindset. It's the end result of a strategy that understands its impacts and dependencies of nature and society on that business. And sustainability professionals need to address that in a commercial way. You need to be identifying what are the impacts and dependencies that this business has on not only you know, natural capital, social capital, but all of the areas that we now have a lot of data to confirm what the impacts are. So we should make this as commercial as possible. We should also do what Joe said earlier, and not just frame this as the negative, but also as the opportunities that exist for businesses to pursue this agenda. Sustainability professions need to talk the language of business, and they need to put this where possible into mainstream decision-making activity that the business has. And if they can start to do that, then management can't ignore the data that they're getting. They need to use data, and that's the other thing, and I'll end on that. But I think too many sustainability departments are focusing on qualitative perspectives. You need to ingrain this into data, and that data needs to be investment grade, and there needs to be investment in ensuring that that information is available at the time decisions are made. And that means bridging gaps inside the corporation to work with finance, to work with strategy, to work with all of them to be able to integrate this important information into decision making.
Oh, I think we have lost Marty, and just as she left, she said, "Oh, Joe, could you just take over chairing?" So she's back.
Oh, she's back.
She put me in the hot spot.
Good, I'm so sorry about that. Sorry, I've got a bit of an unstable internet connection this afternoon. Now, so how about I hand to Joe since you've started, and then we'll do Bob, and then we'll just have one quick slide before the end.
I think education, you won't be surprised. I think education and awareness is absolutely critical, and there are more and more people becoming educated and understanding the risks. I think it's become front and center. I think the risks are real, as Rodney said. They may not be immediate for some companies, but they can move very, very rapidly. Financial markets, when they get a shift, they can suddenly, you find a company with virtually no value. And that's because not only is it disclosures, but it's beyond disclosures as well, because there are companies out there that are making sure that, you walk the walk. So there are real risks if you disclose things that you're not actually doing. So I think we're entering a new world, and it can't happen quickly enough.
Bob.
Yeah, and the only thing I would add to that is I always found in my career that risk management is a when you phrase things appropriately, it's kind of a trump card. If you go to a trader and say you've got a risk and the trader says don't worry about it, you go to his boss or the boss's boss, and eventually you can work your way up to the the leadership of the corporation, and they will respond.
Brilliant. But just before we end, I'm going to draw your attention. For those of you that know, I came into 2020 going, this is the year of action. So I never finish a presentation or a session without leaving you with some resources and some to-dos to go away and educate yourself and learn from this. So firstly, this webinar today has been recorded. So share it with everyone and if you are having trouble having those conversations internally, you can always send them a link to this webinar and they can get a good start. Likewise, Joe has mentioned there's some fantastic resources available on the GARP website, on the TCFD Knowledge Hub, on the CDSB website, on the WBC website, and we'll make links to all of those available with this recording as well as links to all the speakers' biographies and all the things we've talked about today that you might have had the speakers mention as well. So all the resources will be there for you to start to action maybe some of what you've heard today, or have that tricky conversation, or just upskill yourself, because it's a really good area to know more about. Thank you very much to Joe, Bob, Rodney, and my team and Joe's team for pulling together this session today. We've got some really nice feedback coming through in the chat, so please do join us again for future webinars. And I hope you all have a fantastic rest of New York Climate Week, and I hope you'll join us again either later this week. We have an update on TCFD and COP26 with Nigel Topping in the TCFD Secretariat tomorrow, and we have a raft of them going on over the next few months, really capacity building in this space with, again, some of the people you see on the screen today. So again, thank you to our speakers, thank you to the audience. The questions have been great, and I hope we see you all again soon. Thank you very much.
Hi.
Excellent.
Thank you.
Bye.
Bye-bye.